It's a definite privilege for me to introduce our guest speaker today. Tom L. Ward is Chairman and Chief Executive Officer of Capstone Energy, LLC, an Oklahoma City-based oil and gas company. The company was launched in September of 2013. Prior to that time, he served as Chairman and Chief Executive Officer of SandRidge Energy. And SandRidge Energy was from June 2006 through June of 2013. From 1989 until 2006, as you all know, he served as President, Chief Operating Officer, and Director of Chesapeake Energy, which he co-founded along with Aubrey McClendon. From 1983 to 1989, Mr. Ward was an independent producer of oil and gas in partnership with Mr. McClendon. Mr. Ward owns TLW Land and Trading, LLC, which invests in, it's TLW Trading LLC, which invests in commodities, both physically and financially. His team is focused on energy with a bias towards North American natural gas markets. Heritage Feeders LP and TLW Land and Cattle Company LP are owned by Mr. Ward. And it's interesting to note that Heritage Feeders is among the top 10 cattle feeding operations in the United States. Mr. Ward is also a stockholder in Bank Central NA, which is headquartered right here in Alva. Whitefields is near and dear to Mr. Ward's heart. It was founded in the year 2000 by the Ward family and is a nonprofit organization that cares for Oklahoma's most severely abused and neglected boys who are in the custody of the state. Whitefields serves boys aged 8 to 18, helping them regain their ability to trust, heal emotionally, broaden relationships, and develop into adulthood. In addition to Whitefields, the Tom L. Ward Family Foundation supports Oklahoma-based organizations that display compassion to the poor, as well as those that provide care, education, and second chances to the imprisoned. Mr. Ward graduated from the University of Oklahoma in 1981, and he graduated with a bachelor's degree in business administration, petroleum land management. He has been married to Cherie since 1978 and is the proud father of 4 and grandfather to 8. Please join me in welcoming our friend of all Oklahomans, Mr. Tom Ward.
All that goes to say, the older you get, the longer that is. Thank you, Bill. Thank you to the Kiwanis, the Rotary, and the Woods County Minerals Association for having me here today. I've always liked coming home. I like, as most of you know, I grew up in Sealing. My wife grew up in Winoka. I probably said it before in my time here at different functions, but Cherie and I had our first date right here on campus whenever she was in high school and I was in high school, visiting whenever I was playing baseball at Winoka for a summer American Legion team. So we go a long ways back through northwest Oklahoma and in Alva and Winoka and Sealing in particular. But as I prepared to talk today, I thought is that there is good news. One of the things, though, I think about as I was, as Cherie and I come back up here and visit, is that Alva would be the perfect place to retire to. So, and I tell Cherie, it's a wonderful community. It'd be fantastic to come back home. And she keeps wanting me to go to Phoenix. I'm not, so I just started another company instead of doing either one. So as we dig in a little bit, today I'd just like to talk about oil and gas in northwest Oklahoma and what just one man's view is and where we're at today. And as almost all of you know, in commodity cycles, you have ups and downs. So we're in a commodity cycle now, in a down cycle in both oil and natural gas. And as we talk about the cyclicality of energy and the energy business, we know that today, energy prices will move higher. It's my opinion that, not to say that we won't go past the old low that we had in the last few months, but on oil or natural gas, but that the fundamentals of the energy business are at a price that we will see higher prices in the future. And as I think about that, we are putting our money where our mouth is. Capstone has just made an acquisition in the fall from Apache that has properties in the Mocaine-Laverne field out by Laverne, with an office in Laverne, one in Chickasha in Grady County, and another out in Elk City where we bought into the Granite Wash play. We continue to drill in Kansas for the Mississippian play that we picked up from Shell in early 2014. And then we have a rig running just down south of Sealing in what we call the Deep Mississippian and across Dewey County. So we believe, and what I'll get through in the talk is that natural gas and oil prices are structurally too low today, and that you overshoot to the upside and you overshoot to the downside, and I'll try to explain that. So my good news for today is that there will be rain. We are going to have a crop, and we just might have to go through a little bit of time here, some drought, but it will rain, and there will be wheat, and we're all going to be okay. So as I try to explain that, you can see on the chart that West Texas Intermediate crude is down 54% since June 2014, and that's come about fairly dramatically. And the last time this did it was in the recession in 2009, and it was about the same type of dramatic downturn. But this time, the forward curve, so this second graph is just a graph that shows West Texas Intermediate. The green is as of 2014, October 2014, and the red or orange is April of 2015. And you can see the drop at the left is near the near term. You can't read it up there, but that is the exact date. And then you're looking out in the future market. And what it shows is that in 2014, the market was backwardated. In other words, the market felt like that prices were high and they were going lower out in the future. And in 2015, the market is in contango, or it's set to where it's saying prices will go up in the future. So but the interesting thing about this slide is in 2009, when we had the dramatic reversal in crude and in natural gas, the market was moving faster up in the future. So you had more of a V-shaped recovery projected by the oil and gas futures market. And that meant that you could project into the future that prices were going to be high enough, and you could actually sell those into the market if you're a producer and at a much higher price. Well, today, at about $65 of West Texas Intermediate crude is about as high as you can get over the next 5 years. And that, I would say, is fundamentally too low for oil companies to be able to invest in the future at this time. You can't go forward and sell the market and know that you're going to make enough to have a profit. So that is, I think that's one of the fundamental reasons that the price has stayed, or that activity has gone lower and will stay somewhat lower for a longer period of time than it did in 2009. But if you look at why we're here, any time in the past that the crude market has gotten over $90 per barrel in West Texas Intermediate, it happened for a very short amount of time. So the blue is below 90 and the red is above 90. And what that shows is that once you have the market above $90 in West Texas Intermediate, you're going to get supply. So producers will drill, will find a way to come out with more oil, and it's going to bring oil to the market, and we're going to have an oversupplied situation. You never know how long those will last, but it will happen more than likely even in the future as prices get up here again, that it will have another retraction. Now, not all of them are as steep as this one. You can see in the explanation of why did crude drop, the OPEC today produces 30 million barrels a day of crude. In 2009, it produced 30 million barrels a day. But then the non-OPEC areas, especially Russia and the U.S., have become the swing producers for the country. So today we see OPEC has moved themselves away from being the swing producer or the producer that was able to supply all the oil to the market at any time they wanted to, and to where today they have to force out the United States because we have the highest cost product to bring to market. So it takes time. It takes time to force someone else out of the market. So they're not decreasing their production, and they're going to force the United States to back off, which has happened. So you can see the rig count has gone down dramatically, and production has started to peak. We believe that production is peaking right now, that more than likely over the next few months, and for sure by the end of this year, oil production in the United States will be going down. And that will be the catalyst for prices to move back up. So in OPEC's defense, Saudi Arabia in particular has a very difficult time producing over 10 million barrels a day. I read a statistic that said that the OPEC countries have about 2 to 4% of excess capacity today that they could bring on. They claim to have more than that, but this article was making a point that they had 2 to 4% of excess capacity they could bring on today. But in the 1980s, when Saudi Arabia in particular was the swing producer for the world, they had about they had about between 20 and 30% of excess capacity they could have increased at any time. So other than decreasing production to make the market stabilize, the Saudis really can't do very much. As prices go up, they can't bring more production to the market. So that's how come the U.S. with a higher cost of production, or a higher cost of bringing on crude, became the swing producer. And that's all fairly simple geology. Is even in the non-OPEC countries and everywhere else around the world has a better quality of rock than the U.S. With us drilling tighter and tighter rocks over time, we have better infrastructure and we have a better capital system, and we have entrepreneurs willing to use technology to get oil out of harder to get places. So those are all been in the favor of us increasing production. But this time, the Saudis decided, with good reason, that they cannot continue to cut back because all we would do in the U.S. is bring on more oil and take them out of the market. So it had to be a correction in order to make companies like ourselves cut back on their CapEx program and production. And that is happening right now. So why won't WTI stay low for long? Well, I've already hit on some of this. The oil rig count has already dropped over 50%. So we had 1,609 rigs running in October 2014, and today we have 802. The CapEx of the companies that are drilling today in the U.S. are down over 40%. And no matter how many times people say it doesn't matter how many rigs are working, it does matter how many rigs are working. Oil and gas they just don't come up out of the ground without somebody drilling a well. And yes, we can be more efficient, but you still have to have the rigs working. As I mentioned, we think that oil will peak in the second quarter of 2015 and could be peaking as we speak right now, and that by the fourth quarter will be lower year over year between 2015 and 2014. So lower in 2015 over 2014. So we are going to see significant declines. And there's really not very much we can do today to affect 2016. So 2015 budgets are already in place. We're going to have less rigs working. Oil will be declining. And it's impossible to put rigs back to work fast enough in order to not have an overreaction again as we move back up, in my opinion. So the non-OPEC supply, that was the other swing producer I discussed, they are in the same boat. At anything less than $70 a barrel, it's uneconomic for the Russians, the Latin Americans, or the North Sea to be able to have a sustained profit. And demand for oil continues to grow. So we believe that the West Texas Intermediate crude should rebound to a price that balances supply and demand and average out about $85. We could even see a reaction back above that, waiting for that for supply to come back online if this stays down longer than we anticipate. Also, natural gas is near the lower end of its 5-year range. In fact, if you were to go back to 2000, there's not a time since 2000 that natural gas has been lower as you look out in the front 6 years. So from now, 6 years out is the lowest price curve that there has been in the last 15 years. And in our opinion, prices will also be moving back fairly dramatically in natural gas. You can see here on the chart how that curve has been. Let's see, here's the forward curve we look at in natural gas. And the same thing we have going on here is that in 2014, in May of 2014, the price was $3.74, and in April of 2015, it was $2.71. Today, we're at $2.55. So there's been a dramatic change, and it's gone all the way out in the curve. And so oil companies can't really drill for oil to find gas because oil is down also, and natural gas prices are too low to be drilling for natural gas. And in fact, we have the lowest rig count today drilling gas wells ever since 1987, when Baker Hughes first started making not projections, but whenever they would come out with the weekly rig count in the U.S. So the lowest amount of rigs drilling for natural gas today since the count's been taken in 1987. This is a chart that we look at quite a bit. The top blue is the east. So as you think of the eastern U.S., where most of the capital is being spent for natural gas wells today is in the Marcellus and the Utica. So in Ohio and Pennsylvania are the two big states that are bringing on gas. As you look out, this is a projection from 2015 to 2020. I believe I have that right. Yeah, 2020. And the only area in the country that we project is growing is in the east. So the other areas, which we have conventional dry shale and associated gas, are all falling, and capital is being spent in the east in very good areas to drill for natural gas, and that's overcoming all the declines of the other areas. So as you look at natural gas growth, the demand picture is changing. And this is the key to natural gas, is that we already have in place a growth of about 24 BCF a day. So if you go back to that last chart, that growth in the north, if the Northeast completely fills up all the capacity that can be built to the Northeast, that will only be about 18 BCF a day. So the demand picture out to 2020 that's already set in place between industrial demand, Mexican imports, LNG exports that are already contracted. So that these contracts have already been sold, and they're already made, is 7.7 BCF a day of LNG exports, power generation, and others, which we count as just a reduction in Canadian imports in natural gas vehicles. That adds up to 24.2 BCF. So the point there is that there should be a supply imbalance unless price moves as you go out to 2020. And we just try to show that here, is that the demand, the key to this is that the demand that's happening is happening in the Gulf Coast. So it's not happening in the Northeast. The Northeast has become a supplier, and the demand is at the Gulf Coast. And so we believe you can be 5.7 BCF a day undersupplied at the Gulf Coast. And why does that matter to Oklahoma? Is because our gas is easily accessible to the Gulf Coast, where demand is being generated. So that's just what this slide says, is that the changing supply and demand landscape in the U.S. For most of our lives, the producing areas, Texas, Oklahoma, the mid-continent, the Gulf Coast, produced most of the oil and gas, and we shipped it through pipelines to the Northeast. And so demand was always increasing in the Northeast, and we were the supplier of natural gas. Over the last few years, that's changed, and now the Northeast has an oversupply of natural gas, and we're balanced today. And why we have low prices is that the demand that I've showed from 2015 to 2020 is just now starting. So we can go forward for some amount of time and have still low prices of natural gas. But as the excess supply in the Northeast moves to trying to move gas back west of the Mississippi, it becomes hard to do. And that's why our conclusion is that there will be higher oil prices mid to late 2015, and then higher natural gas prices in at least starting in 16 and moving up. We think that takes basically a $5 natural gas price, and we're projecting $85 crude over the next few years. And that's our belief in order to get companies to go back in. And if we're going to become the swing producer for the world, that's what requires us to be able to make money and invest in the United States. So I think the impact on western Oklahoma is that there will be higher rig counts coming back here by 2016. And we believe that the local basis, so it's what we call Henry Hub is in the Gulf of Mexico, that's going to be undersupplied, so prices at the Henry Hub should be moving up, and that will allow the local basis here in Oklahoma to be nearly the same price as Henry Hub, which should be a higher price than in the eastern United States. So it's a little bit technical on some of the terms, but I'm happy to take some questions and answer anything that I can. Thank you for having me.
I have a question. Historically, when there's unrest in the Middle East, it typically drives the price of oil up, but with what's going on right now in the Middle East, I mean, Saudi Arabia is actually bombing other countries. How come the price of oil isn't going up because of that unrest?
He has a great voice, so you probably heard that, but I'll still say it again. So the question is, why do we have the price of oil going down when we have so much unrest in the Middle East, especially with even Saudi Arabia bombing their neighboring country? The answer again is just it's simply oversupply. Is that if you look back at, if I can find it quickly, this chart, that today we are basically 8 million barrels a day higher than we were in 2009 on oil, 8 million barrels a day. So we're about 2 million barrels a day oversupplied as we sit today. And what the Saudis didn't really affect supply. It should affect in normal times. You're exactly right. That just makes there to be unrest, uneasiness in the market. But the market feels like that we are currently have all the supply we need, and you have to drive prices low enough that we, the swing producer in the U.S., quit drilling. And I think the market will stay there until it's proven that our oil production is going down. There's also a theory that we've become so efficient in the United States today that with fewer and fewer rigs, we can continue to grow production. And that's what did happen in natural gas. But in my opinion, that's different in natural gas because in oil, there's not another Marcellus. There's not another Pennsylvania or the Utica in Ohio where the wells are just exceptional, where you can have wells that will come on typically 20 to 30 million cubic feet of gas a day per pad or per well on a 4 or 5 well pad. So tremendous amounts of Dominion South is what it's called in I think that's in Pennsylvania, southwest Pennsylvania. At that hub today, you sell gas for $1.74. So basis is widening and making them to stop. But the answer on oil is the same thing. We just had imports last week, or a rise in inventories that was announced last week, was announced yesterday, of nearly 11 million barrels. That's the most oil that we've had in a week, a gain in oil since 2001, I believe. And so we have a glut of oil today, but that can change fairly quickly, especially with refiners today having a full capacity and incentive to be refining products and using as much crude as possible.
I have a question.
Yes, sir.
Do you have any ideas as to the impact on Woods County and the Alva community as to any oil producing firms or drilling firms or infrastructure that we have here that will not survive this?
Do I have any thoughts? Okay, so thoughts about companies that are in the Woods County area, the Alva area, that might or might not survive the downturn. Is that fair? Mm-hmm. Sure. I think that if I actually don't know if companies will survive or not survive a downturn, but I do know that someone else, if they didn't, will pick up where they left off, just like Capstone picks up where somebody else left off. There's tremendous amount of capital in the United States for energy, and there's no better way to enhance our life than oil and natural gas. So we can talk about wind or solar or other ways that are good on the margin, but they can't affect the way we live. And I don't think the majority of us or the majority of the United States wants to go back to a way of living that might have been like our grandparents or before that. So I do believe that there will be continued demand increase, and that fossil fuels will continue, at least for my lifetime, to be the main ingredient for living in the way that people have become accustomed to. So that doesn't answer specifically about any particular company, but I do believe that there will always be demand for good properties. And when you talk about Alva and Woods County in particular, it's just a good place to be geographically and geologically for oil and natural gas, as it has been forever. Yes?
How do you balance the oversupply of labor, the oversupply of equipment versus the lower prices versus the higher cost of drilling in the future and the potential increased prices? How do you balance all that to utilize your best financial resources?
So let's see if I can get this right. How do you balance the oversupply of equipment services with the oversupply of oil and gas?
Versus the potential higher cost of drilling in the future and a higher price. So
versus demand in the future. So that's a good question. What we've seen in the past is that oil service companies are just like producers. They tend to overbuild when things are good, and then tend to have to cut back when things aren't so good. And none of us knows when these cycles begin, and for sure no one knows when they end. So you tend to have oil service companies today that are somewhat overbuilt, and they're going to have to lower their prices. And we project at Capstone that our total well cost will be going down about 15%, and that encourages us to try to drill. We're in a very good financial position, so we can move a little faster than maybe some of our peers, that as recovery comes, to move in and start to pick up some of that excess supply at lower prices. So the very best time to drill a well is if you have a belief that prices are going to be higher and you can use service costs at their low. And so there's a margin of time that's a very good time to be drilling a well and the most profitable. I think back to the discussion that Lynn had, is that with the amount of capital that there is in the U.S., that we will bounce back from this fairly quickly, and rig counts will go up and service companies will be busy again, because demand is going to offset the dramatic decline in supply. That could be longer than I anticipate. It might be in 2016, but today's rig count and the amount of decline in oil that's coming has to be met with a supply reaction in the U.S. And I don't believe that the Saudis or OPEC in general can offset that, so it has to come from us. So that's the assumption, is that we are the swing producer, and I think that bodes fairly well for future services. But it could be especially in the service business, could be a very rocky year or 2 years. Yes, on the back.
Could you comment on this rush that we had in most of the Alva Basin in Nebraska and on in down into Colorado.
Because I heard the last part about Nebraska and Colorado. I didn't hear the first.
North Dakota, Nebraska, Colorado, there was a enormous rush in drilling in there for a time. Partly it was stymied by the lack of transportation out. What do you foresee in the short term there?
Okay. So we've seen a rush in the past in North Dakota and Nebraska and even down into Kansas and Oklahoma of a rush of drilling, and that was brought about by I think you asked about the lack of transportation. What do I see there? I think we are seeing in all across all areas of energy that there's been a dramatic reaction down in rig count, a dramatic reaction down in people that are working, and it goes from the field all the way to the home offices. There's been cutbacks, and it's not a pleasant time. It's not a pleasant time for people that are going through those problems. It's not a pleasant time for the executives that have to make the cuts, but it has been dramatic. It will be dramatic. I think this year is still problematic for most companies, and the amount of capital that they're having to raise just to, especially the ones that have been over leveraged, or having to put that more to balance to make their balance sheet better rather than to drill. So I think it's as in all things, it's usually good for some and not for others. And for companies that have kept themselves with fairly low debt to EBITDA or earnings ratios and have the ability to drill, it's going to be a little quicker than others. But I do believe we're going to continue to see a down cycle for some time, months anyway. Now, for those that, like most people here that are especially in the mineral side, you tend to live in much longer cycles than an average company or an average service company. And as I think of people I've known all my life, that people who came from Northwest Oklahoma are used to and almost can take pride in being able to sustain ourselves through hard times. And this is just one of those times. And it will get better, but it will be hard on the companies that supply us for a while. And I don't know exactly what happens to all the companies, but I know that in the end, there still is the resource here, and there's still the resource in North Dakota. And we are getting better at finding oil in rock that wouldn't have been produced in the past. So if you think about even the area that's being produced more around around Alva and over to Cherokee and up into Kansas, that zone was not seen to be productive for generations because of how much water it produced. But we found a way to get that oil out, and it helps whenever prices moved up to make it profitable to be able to explore it. And I think we're going to continue to see new zones being produced all across the U.S., but especially in Oklahoma, because geologically we sit in a very unique area that has stacked pay. So starting at nearly the surface, going all the way down to granite, and that can be 30,000 feet deep, there is rock that has oil and gas in it. And so it's up to us to find a way to economically get that out. So I think that a long way to answer your question is that cycles will happen, and my belief in North Dakota and others is that will also move back just like Oklahoma will. Oh, this man back here.
Yeah. On the one hand, we're sitting here and we're oversupplied. You know, with storage numbers up, everybody's oversupplied. You said basically $70 a barrel is where it needs to be profitable for a lot of companies to sustain it at that level. So is that number significantly lower for our peers and competitors, because we still import tons of oil, whether it's with OPEC, Venezuela, wherever? So is their cost significantly lower than $70 a
Yes, so the question is, if we make a claim, like I made a claim that it costs $70 a barrel for the U.S. to be profitable to grow supply, we see others continue to drill wells outside of here, especially in OPEC and other countries. Is their ability to produce, can they produce at a lower price? And my answer is that I believe yes, that they can. That the typical reservoir being drilled in Saudi Arabia is usually a sandstone, and it usually has higher permeability and porosity. They don't have to go to the lengths of drilling in very hard rock that can produce a lot of oil, but it costs a lot of money to drill it. So that's just the difference in the amount of oil per dollar spent is lower in other countries in the U.S. just because of how much we've drilled over the last 100 years versus the countries that haven't had to do that. So as we became the swing producer, that does mean that the oil needs to get above the point that we can bring it back on supply. Yes, ma'am.
At this time, are you allowing people to buy stock in the company?
So at this time, are we allowing people to buy stock in Capstone? Yeah. No, Capstone is private. My days as a public company CEO, I think, are over, according to my wife. She's told me emphatically that I'm not going to be a public company CEO, so I believe her. And so no, we're not going to sell any stock. But thank you for asking. Yes, sir. Back.
What's the chances of getting the Trans-Canada line down? The pipeline.
What's the Trans-Canada?
What's the chances of getting the Trans-Canada pipeline built?
So what's the chances of getting the Trans-Canada pipeline built? I used to think that they were pretty good. I don't see a reason that it shouldn't be, just from that it is competition oil coming in, but I don't see a reason that it just makes no sense to me that you could transport crude across some arbitrary line that borders a country, and you claim that you shouldn't do that because that it causes issues with air quality, but then they're going to produce that same amount of oil, they're going to move it clear to their coast, and then it's going to take a ship around the world and get here anyway. So it seems to me like you'd be a lot better off you just let them ship it across that line in a pipeline instead of having it be moved all around. But I tend to believe that it's going to be held up by quite a while, and once at some point I don't know, but I guess somebody get tired of trying to fight it. But I don't have a good answer for you. I don't know why we're doing it, and I'm not real sure if it'll get passed or not.
What's your estimate of the Woodford Shale in this northwest Oklahoma area? Do you think someday companies will take a hard look at that?
So what's my estimation of the Woodford Shale in northwest Oklahoma? Do I think somebody will take a look at it? Yeah, people are looking right now. So I have my own beliefs about shale and sandstones and limestones, and my preference is to always look, if I'm drilling for it, I would rather have sandstones and limestones, but as they deplete, you have to go to a more inferior rock, which is a shale. But then you can still find a lot of oil and gas, as we're seeing in shales. The Woodford is moving our way. As anybody from Grant County knows, that there's been some extraordinary wells drilled just on the Garfield-Grant County lines in the Woodford. Some would claim that's really coming from a sandstone that lies beneath it called the Meisner. Wherever it's coming from, it's making a lot of oil, so that keeps people back looking to be drilling in those areas. As you move on to the south and east into Blaine County and down into Canadian, right into the Blaine Canadian line, and then over into even northern Custer, you have Continental and Cimarex and Newfield and Felix and I guess Devon continue to drill good Woodford wells. And what we've seen is the the tighter the rock, or at least in the Woodford, the larger and larger fracture stimulations have actually been paying off. So we used to try to make a decision on how much money we wanted to spend and how much we thought was the most effective. And it seems like that the more we're able to get sand, especially into the reservoir, the more oil we're making. So I think that's moving this way. I'm not sure, particularly just around this area, whether it's going to be there yet, but I think it has potential. And it does thin as we get to the north, so it's isolated in certain areas, but the Woodford is becoming more, especially across northwest Oklahoma, more of a target. Yes, sir.
Most of what you've talked about has been rigs count and workers coming in, the transient workforce. What do you see as far as the future in the Alva area of permanent jobs as far as maintenance and infrastructure maintenance for the future? Because someone like me isn't interested in all this stuff that I have no dog in the fight, so to speak, but I want people with families in this area.
So what do I think about the people, jobs continue to stay here?
People will bring their families here,
yeah,
instead of just workers.
Yeah, so more jobs coming in, or at least jobs staying here. What do I think if they'll be able to continue to do that? And you don't have a dog in the fight, and actually we all do. If you live in Oklahoma, you have a dog in this fight, because the energy industry is what's going to drive this area, agriculture and energy. And there's not much, it is a global product, but it is something that for everyone to take notice of. So I agree with you that in my opinion, the people have to look after wells. So once you drill a well, the people that are out here, that live here, have jobs. The ones who are drilling the wells, and some of them are transient, some are not. Those are the ones that are more problematic as costs, as the prices come down and other companies are laying off. I'm sure they're laying off people not only that are transient, but some of the people out here. So I think it does change fairly quickly. But if you're, once a well's online, those same people have to go look after it and take care of it. And so I think for the most part, they should be fairly safe. Yes, sir.
How has the recent concern over increased seismic activity affected Capstone directly, and what do you see the future holding as far as increased governmental regulations?
So the increase in seismic activity. So I'm sorry, I didn't catch the first part.
How has it affected you guys directly at Capstone, and what do you think the future holds as far as how it affects you with increased governmental?
Yeah, so talk about earthquakes. Yeah, so how is the regulations or potential regulation on earthquakes affected Capstone, and what might it do to the industry? Really, there's been no effect necessarily on Capstone. We have some wells up in Kansas that dispose into the Arbuckle, but I think that in Oklahoma in particular, this is a Corporation Commission issue, and so legislation really won't happen around it. It's really the Corporation Commission's responsibility, and I think they'll be prudent and look and see. My personal belief is that there's something to do with this in injecting wells along the Nemaha Ridge, which is further to the east, and so the vast majority of areas won't be affected. But I don't know that, and I know that there are a lot of very smart people with their looking at this from both sides, from the energy standpoint and from homeowners and just interested people. So there's no doubt there's been an increase in earthquakes. You can Google that and see it. The question is what's causing it and how can we address it? And I do believe the Oklahoma Corporation Commission is working hard to address the issue. one more.
What about the exportation of natural gas? Redstone, any other? Is that a factor in the price of natural gas?
And what do we think about LNG exports, and is that a factor in pricing of natural gas? It sure is. So we can go to this slide right here. Between 2015, so there's no exports in the U.S. today. So between 2015 and 2020, over the next 5 years, there will be 7.7 BCF a day of LNG exports that are already sold. So that gas is the first gas produced in the United States. That's already sold, and to the Koreans or whoever has made the purchases of that natural gas. That is the single eliminating factor by itself to balance supply and demand. So as we're seeing that we're going to be about 7 BCF a day undersupplied, LNG is the critical factor in that. So yes, that's my whole thesis is around demand is increasing enough that we can't increase supply enough out of the east. We have to be able to drill wells in the west of the Mississippi in order for there not to be a dramatic mismatch. And what happens is that as the mismatch happens, as gas fills up in the east and you have no more pipe capacity, you've got to do one of two things. You either have to build a new pipeline, a trunk line, all the way from the Gulf Coast to the Northeast, and that should take about 4 years. Or you have to have price go up high enough to incentivize people to drill wells west of the Mississippi. And that is where the price comes together at a higher amount, in my opinion. So we think that is $5 to incentivize enough people to drill wells that you should have around $5 gas. Yes, sir.
You mentioned the miser level earlier, production possibilities. Over here, as it pertains to my question, I guess, we have holdings over in Alva County. My understanding, a lot of those, several years ago at least, were found in the miser level. And then I read an article in the Tulsa publication that had to do with the miser. It comes in strong, but it slows down quicker. Is the Meisner level being dissipated to the point it's not productive in this area anymore? You mentioned about moving this way.
And so this is a question around the Meisner is a formation that sits below the on top of the Hunton, which is below the Woodford. So the question earlier was about the Woodford, which is just another formation that sits in a well bore that's being produced out of. And so the question was, is the Meisner going to be productive moving this way, or has it been depleted? This gets a little bit, well, I'll say a little bit I know. So the Meisner is a very good formation. It's very, very hard to find. It's a very porous sandstone that has fantastic wells, but people went broke forever trying to find it in Alfalfa County, trying to drill vertical wells. Nobody else might agree with me. I might be totally wrong. I believe the better Woodford wells have tapped into the Meisner. And so that might or might not be true. And so that's a fairly localized event because so I don't see that being expansive, but once you hit it, it's extremely good. So I don't know how expansive it is. Yes, sir.
What is the vessel pressure on LNG?
Excuse me?
The vessel pressure on LNG.
What's the vessel pressure on LNG? And you're outside of my pay grade. I have no idea. Yes, sir.
What about these old wells that's been there for 20 years, and you're getting like $100 a month, and a mile away they put one of these other wells in, and they get a heck of a lot more than 100. How's this? And we can't get the new well.
So that's a good question. So the question is, he's got a well that's making 100 barrels or $100 every so often, but not very often. And there's a good well next to him that's making $100 all the time. So how does he get $100 all the time instead of $100 every once in a while? Steve? Steve Redgate knows how to do that. So the answer, I think, is that a company that has your lease, that has the $100 every once in a while, should be incentivized to want to have $100 every day. So they should be either, they could either sell it to somebody else or keep it themselves, or if there's a good well sitting next to you, odds are you'll get one. I think Eddie Childs used to say that. This man's been waiting longer, sorry. I got you next.
I'm just curious, have you guys got a plan B in case the Corporation Commission says you guys got to stop this deep injection, the way of dealing with the fluids?
So do we have a plan B? Do you mean like the industry? Does the industry have a plan B? Do we have a plan B as an industry if the Corporation Commission says you have to stop this deep injection? I think so. I think there'll be alternatives. There's other zones, or we'll find out what's the cause. We've been injecting water for many years, and I can't speculate on why this is, because I'm not sure. But if I have a thought that it's fairly localized in different areas, and we'll be able to find if there is a cause. I have no idea, but if there's something to do with the energy industry and causation, we'll take care of it as an industry, I'm sure. And it won't, my belief is it won't affect, it might affect one or two companies for very isolated areas, but I don't believe there'll be an effect across the whole state. Okay, there we go.
If the oil price does come back up as you project, how many years would you estimate there would still be drilling in this area price coming back up? Drilling.
So if price comes back up, how many years would we maybe be drilling in this area? That's been drilling out here well before I was born, and it'd be well after I die. So I don't know. Forever is a long time, but it's going to be a long time.
If we can export natural gas, why not oil?
If we can export natural gas, why not oil? Well, that's a good question. I don't know the answer to that one either. It seems like if you have, there could be, the argument I think against that is that we still import oil. It's a national treasure, and we shouldn't be exporting something that someone might feel like is in short supply. I don't know if I agree with that or not, but I think that's there's probably two sides of an argument. And the people that want to export oil say that there's not, it's obvious that we don't have a shortage of oil because there's a glut, and it's free market, free enterprise to be able to export. So if you're a free enterprise person, you probably think that you should be exporting, and if you're more into government regulations, you think that maybe it's something we should be saving. Yes, sir.
Then after what you said, why would we not just limit the imports?
And why wouldn't we just limit the imports? I believe, you're getting outside my pay grade also, but I believe that we need to have imports because they bring in the grades of crude that we've all become accustomed to refining in the Gulf Coast. And so another reason to import is we produce a grade of crude here that's sweet that needs to go to its own market, and this heavier crude that's being produced overseas needs to be in our refineries that we've built up to be able to handle that. Yes, sir.
Are we producing enough barrels in this area to bring a refinery?
Excuse me?
To bring an oil refinery here?
Oh, okay.
Do you have in Pompa City? We have.
Yeah,
why not here?
Why don't we have an oil refinery here in Woods County?
That will keep families here.
Sure. I'm not quite sure the answer to that. I think that it would be that the areas that refineries have been built have been historically around very, very large fields that were drilled decades ago, and that refinery, that we have enough refinery capacity that very few refineries are needed to be built, and we have enough pipeline capacity that oil from here can get to the Ponca City refinery or the Coke refinery at Medford or others, the one in Thomas. I doubt that that there's enough demand for crude oil or enough supply that's being produced here to meet demand that a refinery would have. Others?
What impact would gas-fired generators have on the price of natural gas? Instead of spending all the money on wind and solar, how would that impact?
Yeah, what impact would gas-powered generators have on natural gas? I think I tried to put that into this other category, that it does matter. That we're projecting that there will be 4.3 BCF a day of demand that comes from this low-price natural gas being able to be used. Yes, natural gas in all forms, from cars to others. Oil prices down this low do hurt to make the switch, but I don't think it's going to be for long. So I think it is dramatic. Okay. Yes, sir.
Well, the mineral owners present, could you tell us an idea of what the terms of oil and gas leases have done since this downturn in prices? In other words, bonuses per acre for signing leases, royalty shares, that sort of thing.
So what I think Bill's asked what have prices done recently as the downturn has happened. There's still some areas that are receiving extremely high lease bonuses. If you get over into western Kingfisher and eastern Blaine, for example, that's a very, very hot area for a couple $1,000s an acre you can lease for. Other areas, as rigs slow down, they're less, but still, I think, vibrant. I still see acreage bonuses in alfalfa and Grant, and even in woods that still command over $500 an acre. And so I don't see that much difference. It may be in the amount of calls you get, but once somebody's interested, I think they still will be able to pay up and give a good price for it. I think I feel like I'm wearing out my welcome. Thank you very much.